Here's something that might sting a little. Every financial trick you think some genius on Wall Street invented, somebody in Baghdad figured it out over 1,000 years ago. Venture capital? Done. Checks? Done. Limited partnerships? Done. And most people have absolutely zero idea. Between the 8th and 13th centuries, while Europe was busy arguing over which feudal lord owned which muddy field, the Islamic world quietly built the most sophisticated financial system on the planet. We're talking contracts, credit instruments, partnership deals, and commercial law that actually worked across 3 entire continents. This wasn't some primitive barter economy with camels and carpets. This was architecture. Real, enforceable, scalable financial architecture. And here's the part that should keep you up at night. Most of it still echoes through every bank, every venture fund, every trade agreement you interact with today. You just don't know where it came from. So let's fix that. The year is 750 AD. The Abbasids just overthrew the Umayyad dynasty. New boss, new empire, new rules. And by 762, they did something brilliant. They built Baghdad, right along the Tigris River, right at the intersection of China, India, Central Asia, Africa, and the Mediterranean. Every major trade route on Earth basically ran through this one city.
Within a few decades, one of the biggest cities on the planet. Silk, spices, textiles, metals, paper, all of it flowing through Baghdad's markets like water through a funnel. But here's the thing nobody talks about. When trade gets that big, that spread out, gold coins in a sack don't cut it anymore. Imagine you're a merchant trying to haul actual metal from Spain to India, across deserts, across oceans, with bandits around every corner. You'd lose everything before you got halfway there. A civilization stretching from Andalusia to Central Asia needed something better than heavy bags of coins. It needed systems. It needed trust you could write down. And this is where the Islamic world had an unfair advantage: relative political stability across enormous territory, Arabic as a shared commercial language, and, this is the big one, Sharia law providing a unified legal framework. Same basic rules whether you were doing business in Cairo, Damascus, or Baghdad. Turns out, rules matter more than rulers, because money isn't really metal. It isn't paper. It's a promise someone will actually enforce. The gold dinar and silver dirham circulated everywhere, sure. Monetary consistency? Great. But coins alone, coins don't build empires. Contracts do.
Islamic jurists developed commercial law covering partnerships, debt, trade disputes, all of it, with courts across thousands of miles recognizing the same legal principles. When your contract holds up from North Africa to Persia, that's when trade stops being local and starts being global. Now pay attention to this next part because it's going to sound suspiciously modern. The Mudaraba. One party puts up the money. The other party puts up the work and the expertise. Profits? Split according to whatever ratio they agreed on beforehand. Losses? The investor eats them, unless the entrepreneur was negligent. Read that again. The money guy takes the financial risk. The working partner risks their time and talent. Both sides' incentives are aligned with actually making the thing succeed. What a concept. If you're sitting there thinking, wait, that's just venture capital. Yeah, it is. Investors funding a project, operators running it, profits divided by contract, losses falling primarily on capital. That structure existed in Baghdad centuries before anyone in Silicon Valley wore a fleece vest. And it did something incredible. It unlocked idle wealth. Instead of rich people sitting on piles of gold, which, historically speaking, is humanity's favorite hobby, capital actually moved into trade expeditions, into manufacturing, into agriculture, into maritime ventures. Money circulated, productivity climbed, opportunity multiplied. But wait, there's a wrinkle. And this wrinkle? It changes everything. Islamic law prohibited riba, generally understood as usurious interest. You couldn't just lend money and charge a fixed rate regardless of what happened to the borrower. No guaranteed returns. No sitting back and collecting interest while someone else drowns. Now, critics look at that and say, well, that's restrictive. Sure, the way guardrails on a mountain road are restrictive. You know what happens without them? You drive off a cliff. We'll get to 2008 in a minute. Here's what actually happened when you banned lazy lending. People got creative. Trade finance replaced passive debt. Profit participation replaced guaranteed returns. Financial relationships had to be tied to real assets, real projects, real outcomes. Finance didn't disappear. It evolved. It got smarter. And, arguably, more honest. Same blueprint, different century. We keep learning this lesson and forgetting it. Meanwhile, merchants still had a very practical problem. How do you move money across 2,000 miles without getting robbed? Enter the Sakk. A merchant in Baghdad walks into a trusted intermediary's office, deposits his funds, and gets a written document authorizing withdrawal in another city. He crosses the desert carrying paper instead of gold. Paper backed by reputation. Paper backed by enforceable agreement.
That Arabic word, Sakk, it eventually became the English word check, the thing sitting in your grandmother's desk drawer, invented in medieval Baghdad. And that wasn't the only innovation for moving value. The Hawala system, an informal network of brokers bound by trust and reputation, could settle obligations between distant parties without any currency physically changing hands. Money moved through ledger adjustments. Not caravans, not ships. Ledger adjustments. People sometimes dismiss Hawala as primitive. It was anything but. It demonstrated a sophisticated understanding of settlement systems, social capital, contractual enforcement, reputational risk, the exact same components sitting underneath every modern financial system, just dressed differently. Here's where I need you to understand something fundamental. All of this, the Mudaraba, the Sakk, the Hawala, none of it works without one thing: law. Enforceable, portable, consistent law. Islamic commercial courts handled disputes across enormous geography. Contracts were documented, property rights were recognized. Merchants weren't operating in some wild west of medieval chaos. They operated within a system that treated commercial obligations as serious public matters.
Now contrast that with Europe at the same time. Feudal fragmentation everywhere. Different lord, different rules, different county, different legal framework entirely. A merchant crossing 3 borders might deal with 3 completely different systems of enforcement, or no enforcement at all. Transaction costs through the roof. Trade networks thin as paper. The Islamic world's unified commercial law crushed those costs. And lower transaction costs? That's the secret ingredient. Lower costs mean more trade. More trade means more wealth. More wealth means more power. By the 10th century, Baghdad was among the most populous cities on earth. Markets thriving, scholars translating Greek philosophy, Indian mathematics, Persian science. Intellectual explosion running parallel to economic expansion. That wasn't coincidence. Prosperity funded knowledge. Knowledge refined prosperity. But underneath all of it, financial architecture. Invisible, essential. There's one more innovation I need to tell you about before this story takes a dark turn. The Waqf. A charitable endowment designed to preserve wealth for public benefit, permanently. You could place assets into a legal trust that funded schools, hospitals, mosques, infrastructure, in perpetuity. Ownership separated from operational control. Continuity across generations.
Sound familiar? Modern foundations and trust funds operate on almost identical principles. Wealth structured for long-term stability, instead of getting consumed in one generation. The Rockefeller Foundation, the Gates Foundation, same DNA, different wrapper. And this is where the story becomes bigger than any single instrument. The Islamic Golden Age didn't just invent financial tools, it embedded them inside a moral and legal worldview. Contracts were sacred, reputation carried weight, financial relationships were constrained by ethical considerations. Every financial system encodes values, whether it means to or not. Some value leverage, some value speculation. This one valued partnership and tangible assets. Speculative excess was discouraged by design. You wanted profit? You participated in actual economic activity. No shortcuts, no phantom wealth. When finance stays tethered to real production, bubbles are really, really hard to inflate. That doesn't eliminate risk, nothing does, but it reshapes it, distributes it, makes it honest. By the 11th and 12th centuries, these innovations were standard practice from North Africa to Persia. Capital crossed borders more freely than almost anywhere else on the planet. And then, The ideas started traveling. Trade routes didn't just carry silk and spices between the Islamic world and Europe. They carried concepts. Mediterranean commerce intensified. Italian city-states, Venice, Genoa, Florence, they weren't just trading with Muslim merchants. They were watching, learning, adapting. The commenda contract in Venice, one partner provides capital, the other conducts trade voyages, profits split by prearranged terms. That's the Mudaraba, with an Italian accent. Risk-sharing, limited liability, capital mobilization, the backbone of modern venture finance, already running centuries earlier in Baghdad. Bills of exchange spread across Mediterranean commerce, settling debts across borders without hauling gold. Different name, same principle. Trust formalized through contract. We keep reinventing wheels that were already rolling. But here's where a subtle and dangerous shift happened. As European finance matured, it diverged. Islamic commercial law discouraged fixed-interest lending, kept everything tied to profit sharing and real assets. European banking? It went the other direction. Interest-bearing debt became the foundation, not just permitted, foundational. And debt-based systems? They scale fast. Interest payments create predictable cash flows. Governments borrow against future taxes. Banks expand credit aggressively when everyone's feeling optimistic. The whole machine grows quickly. But leverage cuts both ways. Always has. Always will.
When credit expands too fast, asset prices inflate beyond anything real. And when confidence cracks, bam! Contraction is violent, sudden, merciless. Which brings us to 2008. The global financial crisis. Not caused by medieval trade disputes, obviously, but fueled by debt, layered on debt, layered on debt, completely detached from actual asset performance. Complex derivatives nobody understood, leverage magnified to insane levels. When trust evaporated, liquidity just vanished. Major Western financial institutions nearly collapsed. Governments pumped in trillions, central banks slashed rates to near zero. Quantitative easing became part of everyday vocabulary. The system that was supposed to be the pinnacle of financial sophistication almost ate itself alive. Progress. Meanwhile, and this is fascinating, modern Islamic finance, smaller in scale, had certain constraints baked right in. Sharia-compliant products require asset backing. Purely speculative derivatives? Restricted. Interest replaced with profit and loss sharing or fee-based arrangements tied to tangible assets. Sukuk, often called Islamic bonds, don't pay interest, they provide returns linked to actual ownership stakes in assets or projects. Today, Islamic finance represents over $2 trillion in global assets, major hubs in Malaysia, Saudi Arabia, the UAE, growing steadily.
Does that make it immune to risk? No, nothing is. But it illustrates something profound about how financial architecture reflects philosophical choices. Debt-heavy systems chase rapid expansion. Risk-sharing systems chase alignment between the person with the money and the person doing the work. Different trade-offs, different values baked into every transaction. The architecture outlasts the architects. Every time. Now, back to Baghdad, because every golden age has a last chapter. 1258. The Mongols arrived. And they didn't come to trade. Baghdad was devastated. Networks shattered. Enforcement mechanisms fractured. Centralized authority, the thing holding the entire financial system together, gone. Just gone. Finance cannot operate in an institutional vacuum. It never could. The moment the legal infrastructure crumbled, the commercial ecosystem crumbled with it. As European maritime powers rose in the 15th and 16th centuries, they carried adapted versions of these financial tools, plus increasingly aggressive debt-based models. Colonial expansion financed by joint stock companies and sovereign borrowing. Risk socialized. Profit privatized. The architecture had shifted, but the DNA of earlier systems remained, embedded in contracts, in partnership models, in trust law.
And that pattern, strong institutions support trade, trade builds wealth, wealth amplifies power, power requires maintenance.
That pattern didn't die with Baghdad. It's operating right now, this very second. Today's global financial system runs on credit expansion. Governments carry massive sovereign debt. Corporations leverage their balance sheets to the ceiling. Consumers finance homes, education, cars, everything through loans. Inflation surges when demand outruns supply. Contraction follows when credit tightens. Financial education loves to focus on the surface, interest rates, stock indices, inflation prints. But underneath those numbers, architecture. How is credit created? Who bears the risk? Who eats the losses? How enforceable are contracts? How stable are the institutions? Those questions determined prosperity in 10th century Baghdad. They determine resilience today. Same questions, same consequences. We just pretend they're new. The rules outlast the rulers. They always have. What the Islamic Golden Age really demonstrates isn't some nostalgic fairy tale. It's design principles. Enforceable contract law scales commerce. Reducing transaction risk accelerates capital flow. Financial systems reflect the moral and institutional frameworks underneath them. And when trust weakens, finance weakens, period.
Today's system, Western institutions, dollar-denominated trade, debt-centric expansion, it feels permanent, doesn't it? Solid, immovable. So did Baghdad in the year 1200. Digital currencies, decentralized finance, expanding Sharia-compliant banking, regulatory overhauls, any of these could rewrite the rules again. History doesn't hand out permanent blueprints. It hands out case studies. And the case study from the Islamic Golden Age is crystal clear. The rules governing money mattered more than the money itself. Partnership over pure leverage, real assets over phantom wealth, enforceable trust over blind faith. That principle survived the Mongol invasion. It survived the rise and fall of every empire since. It'll survive whatever comes next. But here's what won't survive: ignoring it. Most people will scroll right past this, convinced modern finance just appeared out of thin air and will last forever. The merchants of Baghdad thought their system would last forever too. The Romans thought that. The British thought that. Everyone always thinks that. Same blueprint, different century. If you'd rather see the pattern before it repeats on you, the subscribe button is right there. Here at Money Never Learns, we dig up the blueprints everyone else forgot, because the architecture outlasts the architects, but only if you know where to look.